Later CPA and Associates, accounting the grapevine mate.
Hi there, I'm Daniel Later, founder of Later CPA and Associates, and welcome back to our ongoing series, the 20-week Tax Strategy Readiness Roadmap. You can get your firm ready with the best tax strategies. This week's topic is simple, but it affects almost every tax strategy conversation. You need to know your profit before you can make a good tax plan. A lot of practice owners think tax strategy starts with asking, what deductions can I take? That matters, but it's not the first question. A better first question is, what is my business really earning? Because if we do not understand the actual profits of the practice, we are guessing. And guessing is not a tax strategy. The first thing to understand is that revenue and profit are not the same thing. Revenue is the money coming into the practice. Profit is what's left after the real cost of running the practice. So that includes things like your payroll, your contractor payments, your rent, software, insurance, marketing, continuing education, professional fees, owner pay, debt payments, and taxes. So a practice may look strong because it has a high revenue, but still have a weak profit. And a practice may have a modest revenue, but a strong profit because the expenses are controlled. So tax planning depends on profit, not just the revenue. Now, the second point, many tax strategies are based on how much the business is actually earning. So for example, an S corporation strategy depends on the profit after paying the owner a reasonable salary. A retirement plan strategy depends on how much cash flow the business has available. Hiring a spouse or children depends on whether the business can support real wages for real work. Buying equipment or increasing deductions only helps if the business has enough taxable income for the deduction to matter. So before we ask, what strategy should I use? We need to ask, what does the business actually make? Without that answer, the strategy may sound good, but it might not fit the practice. The third point, clean books make better tax planning possible. Now, this is why bookkeeping matters. It's not because the IRS wants a nice report, not because the accountant likes spreadsheets. Bookkeeping matters because it tells the truth about the business. Good books help answer questions like, how much profit do we have so far this year? Are expenses higher than expected? Is owner pay too high or too low? Can the practice afford retirement contributions? Should we adjust estimated taxes? Is the business growing or just collecting more money while expenses rise too? When the books are current, tax planning becomes much more accurate. When the books are behind, tax planning becomes more of an estimate. Now, the fourth point, the profit also shows what the practice can afford to do. A good tax strategy should not create a cash flow problem. This is important. Some strategies reduce your taxes, but they also require cash. For example, retirement contributions can reduce your taxable income, but the money still has to be contributed. Hiring your family members can create a deduction, but the wages still have to be paid. Adding benefits can be helpful, but the practice still needs enough cash to support the cost. So the question is not just, will this reduce taxes? The better question is, will this reduce taxes in a way the practice can actually afford? That answer depends on knowing the real profit. And the fifth point, profit helps to avoid April surprises. One of the biggest problems practice owners face is the surprise tax bill. That usually happens when the profit is higher than expected. And I've seen this many times with a successful practice. Higher profits, your estimated taxes that you've paid are too low, or the business owner does not see the tax problem early enough. Knowing your profit during the year helps prevent that. It gives you time to adjust. You may need to increase your estimated tax payments, adjust your payroll withholdings, set aside more cash for taxes, make larger retirement contributions, change your entity structure, plan deductions before the year end. And the earlier you do these things and the earlier you understand profit, the more time you have for these kinds of options. The later you find out, the fewer options remain. So the main takeaway this week is your tax strategy starts with knowing what the business is really earning. Before choosing any deductions, retirement plans, S-corp strategies, or benefit plans, you need a clear picture of profit. For mental health practice owners, this does not have to be complicated. You need current books, a basic understanding of your profit, and a plan before the year's over. When you know your profit, tax planning gets a lot clearer. When you do not, it's mostly guessing, and guessing is not a strategy. Next week, we are going to be talking about keeping your business and your personal money separate. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us to help you do just that. I'll see you next time. Bye.
For all your tax needs and more.